This program proudly brought to you by IPO Wealth for the sophisticated investor.
Hello and welcome to Money Talks, where we have a very simple goal, and that is to make you richer. On tonight's show, we want to work out if a Santa Claus rally is out there waiting to happen, and then to determine whether stocks will have a good year in 2019. Joining me to wrestle with these pretty important hip pocket subjects are Michael Gable of Fairmont Equities and ST Wong, Portfolio Manager from Prime Value. Gents, thanks for joining us.
Thank you.
Now, let me start with Michael first of all, because you've got some charts and you're renowned to me as a charts guy, apart from your wider evaluation of companies on the stock market. Let's go to which I think is the most important, the S&P 500 index.
Yep.
Because I suspect if this market of ours is going to have a Santa Claus rally, Donald Trump's going to have to do something to help this market see a positive circuit breaker to start heading up. What are the charts telling you at this point in time?
So for the S&P 500, at the moment it's not necessarily giving us signs that it's going to rally today, but it's at the right levels to rally. So when we
talk to that.
Yep. So when I was here a month ago, we were talking about the previous lows in February, March, and what we're looking at is the S&P to retest those levels. As long as it doesn't go through those levels for an extended period of time, it has the best chance to bounce from there. So at the moment, we're back to that zone, that 2600 zone. Doesn't matter if we're a point or two above it, but we're back at that zone, testing those levels. I think there's a couple of key catalysts that will get it going, and that's the interest rate rise on Thursday and the commentary around that, whether there are going to be another 4 next year or not. And of course, Donald Trump, trade wars, all that sort of thing. So,
okay, so you've got the Fed and what the Fed boss says this week, in company with you're expecting an interest rate rise?
I'm expecting a rise, but we just have to, again, see the commentary around that. My opinion is that interest rate rises throughout 2019, they're starting to get pushed back. I think in the US and here in Australia, the expectations for a rise are getting pushed back. And that's good for equity markets. So obviously the fear a few or so months ago was that rates are going up, it's going to put an end to the bull market. Now the expectation is that the rates are going to get pushed back. The long-term yield's coming down, but the market at the moment, sentiment is so bad that we're interpreting that as a bad thing as well.
So rates rising at a slower rate, you think will ultimately be good for stocks. And what you're seeing in the chart, and it's on screen now, the S&P 500, which has just gone off, is actually looking positive. Now, let's just do Australia now, the S&P ASX 200 index, and then I'll talk to ST about his fundamental views as well.
I think our market's looking more bullish at the moment than the US. So again, in the last month, I was talking about our market preferably making a dip under 5,600, and I believe that if that was to occur, we'd see a lot of buying step in with a rally to start about a week before Christmas. That's what we talked about a month ago. So far, it's working out according to the script. So we had that dip under 5,600 last week. Buying came in. We had a bit of a shocker on Friday, but we tested under 5,600 again today and then closed up over 50 points higher. So our market,
wasn't it?
Exactly. Our market looks like it does want to head higher. But the way these things play out is that you get an initial bounce that would last a few weeks, maybe good for a few hundred points. But investors, they're the same time and time again, in that there'll be a lot of investors that will sell into that rally and you get a bit of a dip, and then I think the market will be ready to have a proper sustainable rally higher after that.
Okay, let's go to ST Wong in Melbourne. ST, do you look at the charts to get confirmation about your willingness to buy stocks and the magnitude of your commitment to those stocks?
Peter, I don't actually look at the charts. We're pretty much fundamentally based. So we don't look at a broader environment to get a sense of what's happening in the market, to get a sense of what the sentiment is like, to get a sense of what people are thinking about. You know, we talked about interest rates, for example, the trade war. Circumstances like that does dictate fund flows or liquidity flows. But very much we are very much bottom-up driven from where we sit, Pete.
Okay, so from your point of view then, you obviously can't ignore the fact that you've been going through a macro correction at least, correct?
Absolutely, yes. Agreed on
But
that.
from your point of view then, it either gives you a signal that there's good value in companies that you like, but can ever the signal be, it doesn't matter whether you like these companies or not, it's smart to get out of the market altogether and go to a big holding of cash?
Absolutely, and that's what we've done pretty much in the last 2 months. Despite value emerging from a number of Aussie companies, we're sitting on quite a high cash position, so roughly about 20%. And the factors we've just discussed early on, where the Fed goes from here, will dictate the market direction, I guess, in the next couple of months. And that certainly has implications on where to place our resources or our funds.
Yeah, so do you want to see, I referred to it as a positive circuit breaker, or whether it be Donald Trump saying, negotiations with China are looking good. He said that before and then changed it the day after. But if he said that, the market would like it. And if the Fed boss said, well, look, we think the US economy is growing well, but we don't need to raise interest rates too quickly now, but we still think the economy is going to grow around 2.5% to 2.75%, would that make you feel confident that it's time to go looking for those companies that you think are good value?
I think broadly, Pete, the market is certainly looking for a circuit breaker, whether it's Trump with trade or the Fed with rates. So if any one of these two factors come in on a positive, I think the market does have the chance to rally, at least in a short term. And certainly that's a catalyst that we would start to think about, where to place our funds from our cash positions. Look, from my position, Pete, is going to 2019, expecting volatility, but that's not a bad word. Volatility will introduce opportunities, and that's what we're looking for into 19.
Okay, now that's a subject I want to focus on in the second half of the program, where I'm going to ask you the companies that you think are really well positioned for 2019. But just in simple summary before we get there, are you of the belief that 2019 will be a better year for Australian stocks and the stocks that you're selecting than, say, 2018? Even though you might tell me you've had a brilliant year in 2018, Estine, that's why you're on the show.
Look, I'm certainly expecting 19 to be better than 18. I think we have factored in quite a lot of bad news, ranging from large cap banks, Royal Commission, slowdown in the housing market, and what we see now, softening in retail or the consumer. So we have taken quite a fair amount of bad news into share prices, and certainly from my perspective, I think 19 should look somewhat better. The caveat, perhaps, if I could put one in, Pete, is how elections might come through in, say, May 19. And that could throw in some, I guess, a curveball into where the market is trading for 19. But certainly looking for a better 19.
Okay, now, Michael, just going to you then, to set up for the second half of the show. The charts are looking good now. Do the charts give you the suggestion that 2019 will be a better year for stocks, particularly for Australians? Because we're down about 7.5%. I guess if you've got a reasonable income dividend, you might be down 2.5% or so, but that would be a pretty good dividend return. Are you more confident that 2009 will be better than 18?
I am from a macro perspective, but I mean, firstly, looking at the charts, just looking at the S&P 500, I think what 2019 has been is basically just a correction against the preceding trend. So the preceding trend was going up.
Solid.
We've now taken a breather. We've had a 10% pullback, or a little bit more than a 10% pullback from the recent highs, and that's not that unusual. 2017 was a very unusual year. It's not unusual for every year or two to have a bit of a breather of 10% and then you get going again. So based on the charts, yes, I think 2019 we can see both markets go higher and make new highs compared to where they were this year.
And I guess 2017 was a pretty good year.
Yeah, it was a very good year, but these things don't last, the record low volatility.
If we average it the 2 years out, it might be a reasonable average.
Yep, you're still up.
Yeah. Okay, so we're going to that break now. These guys are going to stay on set with us. I'm going to be bringing Julia Lee in after the break. She's got, as we know, she always searches for the hot stock of the week. This time she's going for stocks for the Christmas stocking. Stay with us. Welcome back. I'm joined by Julia Lee from Bill Direct to talk about what stocks are good for your Christmas stocking. What a great idea. I always leave this up to you and you come up with great ideas.
I hope so.
Yeah, I guess you wouldn't be here if you didn't. All right, so what's the... we know the theme's Christmas, but what's your selection theme then?
I thought I'd start off with a stock for income investors because it's been a tough year for income investors with Telstra stock and QBE cutting its dividends.
And the threat from Bill Shorten as well.
With the franking credits. So I guess the big lesson is that when you're looking at dividend stocks, you want to see that growth in revenue as well to ensure the stability of the dividend. So the stock's a smaller one in the healthcare space. It's called Paragon Care. They're an equipment provider, so they stock things like hospital beds, mattresses, stainless steel equipment.
So they don't have the sovereign risk threats that...
No, there's no currency risk there. But they also provide the equipment to the aged care providers as well. And at the stock price it is at the moment, it's a 6.3% yield. Really? Which is pretty hard to find on the market.
Obviously it's consistently done that because you wouldn't be talking about them, is it?
Well, it's made a few acquisitions, and look, organic growth in the last update up to the 31st of October was 7%, which is nice to see. So you've got that organic growth coming through, but the acquisitions that they've made means that in the second half of the year, they're going to have to bed down those acquisitions through a cost-out program, and hopefully the synergies will start to come through, and that will help to boost performance as well. So Paragon Care, I think 6.3% yield, I think it's looking pretty good there.
Okay, what else you got in the stocking? You're not going to have a stingy stocking with just one stock in it, eh?
Well, talking about stingy, you've got to give one for the shoppers, given that it's Christmas season. Look, retail's doing it really tough, but one standout stock in the retail sector is baby bunting.
Yes.
And it's great when your four major competitors...
You've stopped having babies, haven't you?
I have definitely stopped having babies, Pete.
That's a new revelation about your baby habits, yeah?
Yes, but it's great when four of your major competitors go belly up. So,
really?
Yeah, so it's the last baby shop standing.
It was terrific, 3 or 4 years ago, had a fantastic run, then it had a bit of a challenge, and that obviously companies were coming and eating their lunch, and now they're not
Last one standing. And look, the thing about big ticket items like prams is you don't want to buy it online. You want to test drive it because these are feats of engineering. They're pretty hard to open and close, so you want to give it...
And you don't buy second-hand ones because they've really been beaten up and there's food all over them.
Well,
you can't clean them up.
Not just food, but a few other bits in there
Let's not go there.
as well. But look, same-store sales, like-for-like sales, about 9.5%, and that's probably going to speed up because of the weakened competition that we're seeing in this space. So in the retail space, doing it tough, but baby bunting's in a good position.
So Paragon, baby bunting, anything else in this stocking of yours?
Well, I thought I'd give a growth and a specky one. Which one would you like first?
Four in total. This is a bonus night. Go on, way go.
Well, Aristocrat Leisure, I've been waiting on the sidelines.
A bad day today too.
Yeah, the share price has fallen to $22, so I think it's time to start accumulating the stock. Yeah. It's the dominant player in the Australia, New Zealand and the Americas regions. But look, with a gaming stock like Aristocrat Leisure, you live and die by your games, and so it is all about the games. But the good thing is that they have been diversifying their revenue. So their latest acquisition of Big Fish, that's the second acquisition in the social gaming area, which is a high growth area. And I guess if you have a look at revenue, 2/3 of it's reoccurring now. So pretty stable revenue base.
So why has the market been so nasty? Is it because the US market's in a bit of a downspin from the correction and therefore they don't like Aristocrat at the moment, but all the analysts like it, don't they?
Well, it's a growth stock, and I don't remember the global financial crisis. It was so long ago.
Oh, rubbish. You were working for Comsec then, weren't you, or something?
No, I was still at Bill Direct.
Okay.
But Aristocrat Leisure didn't do so well in the global financial crisis. But that's not just because of the stock. It had other management, other issues back then as well. So, look, I think the market's discounting Aristocrat Leisure because the market's a bit nervous about global growth.
Okay, your last one.
Last one's total specky, called Live Tiles. They were originally known for their intranet tools to make your company intranet very easily, but they're they have a partnership with Microsoft. And in fact, Microsoft has this conference once a year called Inspire, and they won an award at that Global Inspire conference. It was the Workplace Transformation
In the US or
Award.
here?
It's a global award, so
Okay,
it's a
that's
massive conference. And what LiveTiles is doing at the moment is targeting some of those Microsoft partnerships here in Australia with their LiveTiles bot, which tries to take it's like a, I guess, a personal assistant. It tries to take some of those mundane and repetitive tasks of every day out of the equation. And in fact,
using artificial intelligence?
Using artificial intelligence.
There was an episode on Suits, you know, where they tried to replace the secretary in Suits using artificial intelligence.
Is that a new episode? Because I love that show.
Yeah. No, I thought it was season 6, but you know, maybe I'm wrong.
But recently they have they've signed up Canberra University to try and match some of the professors and the questions that might come through from
Professors are very easily replaced by artificial intelligence.
No, you're irreplaceable.
Well, I used to work with them. I can remember them. No, they're all very good people. That's fantastic. Now, Julia's going to be forced to stay on set. I'll keep her hostage, and she'll join Mike Gable and ST Wong, and we'll look at the stocks. I think all three like stocks for 2019. Obviously, Julia's given in 4 already, but I'll make her give us a couple more. So stay tuned, and we'll come back with a whole swag of stocks for 2019. Okay, joining me to wrestle with these pretty important hip pocket issues, again, is Mike Gable from Ephemeral Equities, ST Wong in Melbourne, and of course our own Julia Lee. She's not really our own at all, she's Bill Direct's Julia Lee, but we steal her occasionally. And what we want to do now is just actually try and pick some stocks for 2019. Julia's already mentioned a few, and they're in beauty. Let me just see if ST Wong likes any of the ones that you like. So ST, did you like any of the stocks that Julia was keen on for 2019?
Yeah, Peter, I think Baby Bunting should do well into 19. Industry structure, as Julia's pointed out, working in its favour. We think it should ride out the soft retail environment into 19. So I think overall, I think it's a very positive story where Baby Bunting is concerned. Yeah. Okay.
Well, that's an exciting stock. Who can't be excited about, you know, young newlyweds or older newlyweds having babies? But what about one of those interesting stocks that I'm sure you're looking at right now? Or even if they're uninteresting, as long as they make money, I don't care.
Sure thing, Pete. Look, I'm going to call out Alliance Aviation. The code's AQZ. It's a small cap. Not many investors are into it at this juncture, I feel. Market cap's just under 300 million. So Alliance is a provider of charter flight services to a number of mining companies, especially in Queensland. It's got about 35 operating aircraft in operating nationwide. The great thing is that miners are starting to spend again in terms of mine expansion, mine replenishment, and therefore the requirements for fly-in, fly-out workers is actually an increase, and therefore demand for aircraft leasing services is on the rise. So Alliance is quite well positioned to see continuation of, I guess, contract wins from demand from mining companies. And the best thing, Pete, is that there are really two great things about Alliance Aviation outside the fact that it's not really well known as a small company. First of all, it doesn't take on all risk, right? All the oil price is passed on to the mining companies, so we don't have to worry about where oil prices land, going up or going down. But I think the best thing about Alliance Aviation is that it is really quite cheap at this juncture. 13 times earnings, FY19 earnings, yielding about 6% on a net basis, so that's pretty attractive. And we're seeing growth, you know, kind of in the mid-teen levels, 10 to 12% kind of growth into the next 1 to 2 years. So really strong demand for aircraft leasing services. And it's a company we think, you know, from our position, it is also looking to diversify outside of mining into areas such as tourism, for example.
Yeah. Okay,
so,
mate.
industrial
Okay,
stock.
Julie,
Yeah.
have you ever run your eye across the lines?
So it is a microcap, and when I guess you're looking at a microcap like this, which is in the area of charter airplane services in the mining industry mostly, what you want to see is an expansion in terms of the fleet, because that tells you that they're pretty confident in terms of growth. So I think they make earnings of about 1.8 million per aircraft. There's about $500,000 in servicing fees for the aircraft, because of course they're very expensive things, but I think they're looking to expand their fleet from 32 to 35, so almost a 10% expansion.
You know, preparation, that's a brilliant performance. So you give it a thumbs up as well?
Look, it depends on how commodity prices go, because although I guess it is forecast that we will see a lot more brownfields expansion, which should be good news for companies like this, it depends on commodity prices.
Okay. Mike, you've heard a couple of stocks already.
Yep.
Do you have opinions on maybe Bunting or Alliance? If not, what do you like?
Yeah, look, in terms of Reliance, I don't know it, but I am bullish on the resources sector, so you know, that should do well. And in terms of Aristocrat, I quite like the company. The only problem is everyone seems to like it. So, but apart from that, I think it can do really well. Because look, at the end of the day, 2019, as I said, I think growth will be back to sustainable levels. Interest rate rises are getting pushed out, so your growth stocks that have been hammered, I think they'll bounce back. But the stock I like that I want to talk about briefly is Goodman Group. So real estate investment trusts, another, I guess, sector which could be under pressure if you're getting a lot of interest rate rises, but as that gets pushed back, I think the interest will come back into that sector. Goodman Group has been on a tear since the end of the GFC. So,
and Julie, you wrapped it last week on the program, didn't
absolutely.
you?
I love internet shopping, and this is a beneficiary.
Yeah.
So, look, industrial property, rental growth's improving. Gearing's only at 16%, which is quite low for this sector, which gives them the ability to make further acquisitions. But the point I want to make with this particular chart is not the fact that it's, I guess, making 10-year highs when everything else is falling out of bed, but just the sustainability of that trend. So what I've tried to indicate with that chart, with the horizontal lines, is how price action keeps building on top of previous price action. So it almost looks like a set of stairs heading up there, and with the diagonal lines, you could see it just nicely and gently just sort of easing up there. So it's a very sustainable trend. It's breaking to new high levels. Maybe if the market takes off here, it might get left behind in the short term where everyone scrounges around for all the stuff that's been beaten up. But if you're a long-term investor and you're looking out towards the end of next year, I think this thing will keep heading higher.
Yeah, and your point you made pretty quickly then was this is really well positioned for the online shopping world. Explain why for my viewers.
It's a shift from bricks to clicks, as we call it, and
That's a cool girl, aren't you?
they have multi-story storage solutions
for fulfillment.
For fulfillment,
Yeah.
which is absolutely amazing. So if you think about it, you know, they have this property, instead of one story, they've got multi-story ones now. So it's a real growth story that we've seen in Goodman Group.
We're running out of time. ST, got one last one for the team?
Sure, I'll throw in Amcor. Amcor's been quite unloved, pretty much in the last 12 months. Made a big acquisition a couple of months ago. The market's still digesting that. But what we know about Amcor is that it's well managed. That's point number one. And point number two is that there's a lot of upside if the acquisition goes through well, executes well. 19 and 20 could be a better year for Amcor going into the next 2 years.
Okay, quickly, you like Amcor?
Oh, it's a bit too boring for me.
It's too cool and groovy.
But yeah, it's quite stable.
It's a
and
solid company.
Yeah.
Okay, Mike?
Yeah, look, in the past, geographical issues, you know, they've been unaware of what's been happening in other regions, and it's hurt them, but yeah, one worth looking at again.
Okay, guys, thanks for coming on the program. To all my viewers out there, have a fantastic Christmas and Happy New Year. I look forward to seeing you in the new year, and if you want to catch up with me each morning, just go to switzer.com.au, where people like Julia even stars once a week writing some fantastic stories. Once again, thanks for joining us, and have a great Christmas.
This program proudly brought to you by IPO Wealth for the sophisticated investor.